Afterpay's been an unprecedented success story in Australia, obviously, operationally, financially, and from a share price perspective. And I think along the journey, when you've got a high growth business that's making unbelievable inroads into the Australian retail market and a share price that's gone up nearly 10 times, more than 10 times since it listed, people start questioning the valuation and the outlook for that business. It's worthwhile remembering just some of the bare facts of the business in Australia, that this year they'll account for about $2 billion in retail sales in Australia. They have over 1 million clients on their books, and they have over 14,000 retailers using their system. So it's been some remarkable growth in Australia. Now, coming with that is a market capitalisation of over $2 billion, which arguably could be justified in Australia. But I think the next leg up for that business has been their launch into the US, which they've started this year. They've had $20 million backing by a venture capital firm out of the US called Matrix, and that $20 million has been earmarked to basically put their product into the US. Now, what we've seen over the last couple of months, it looks to be some really, really promising success in that market. They've already signed up live or about to launch over 200 retailers, according to their website. They're already doing business with a number of them over there. And the most exciting thing about Afterpay is that the market over there is more than 20 times the Australian marketplace. Just online, they do something like $500 billion in online sales. So if you look at that potential for a business like that, in a non-real estate driven business that is purely online, purely basically IT and tech driven, so they don't need real estate, massive staffing, the scalability is mind-boggling. And I think the potential profitability, if they get it right over there, is going to be massive. Now, how one relates to that I suppose ramp up in their success over there or not, and how that relates to current market capitalisation is debatable from all people's perspective. But I think it's worthwhile looking at any high growth businesses here or domestically. We've seen the likes of Xero, corporate travel, Domino's Pizza, Blackmores. Any high growth business never looks cheap, and they're always more expensive than investors who aren't invested in them believe they should be. But I think as long as their growth keeps accelerating, and as long as they keep bringing on more clients and more customers and extending into new verticals, I just don't see any reason why the business, the stock price is going to go down, for any significant period of time.